Welcome to Today Finance at Sketching Finance. I'm James, bringing you the latest market updates and expert analysis. Let's dive in. Have you ever felt like the ground beneath your investments is shifting? In 2025, a financial earthquake hit Wall Street. We are talking about a staggering $4.5 trillion in mergers and acquisitions. This isn't just a number, it's a total redrawing of the American corporate map. If you aren't paying attention, your portfolio might be holding on to relics of the past while the giants of tomorrow are being forged right now. Today, we dive deep into the engine of this boom. We'll explore why the Trump administration became the ultimate detonator for these mega deals and what it means for your money. From media wars to industrial titans, the rules of the game have changed. Welcome to the era of the mega deal. To understand where we are, we must look at the scale. Global deal-making topped $4 trillion this year for the first time since the historic boom of 2021. This is the second best year in 40 years of financial history. But why now? After years of high interest rates and caution, the floodgates have finally burst open, driven by a renewed sense of deal confidence. Corporate America is no longer playing defense. CEOs are armed with cash and high stock prices. As Tony Kim, co-head of M&A at Centerview Partners, noted, we are seeing a level of large-scale M&A that hasn't existed in a decade. These aren't just incremental steps. These are strategic leaps to dominate entire industries before the window of opportunity closes. The biggest catalyst? The White House. Under the Trump 2.0 administration, the antitrust watchdog has been put on a shorter leash. Historically, the government blocked big mergers to protect competition. But now, the mantra is deregulation. This shift has signaled to every boardroom in America that the no of yesterday has become the maybe or yes of today. Mark McMaster, the global head of M&A at Lazard, emphasizes that risk appetite is surging because of this supportive antitrust environment. Companies are now willing to take regulatory risks on strategic transactions that would have been dead on arrival just 2 years ago. The green light is on, and the race for scale is officially at full throttle. Let's look at the battlefield of entertainment. We've seen a brutal tug-of-war for Warner Brothers Discovery. Imagine Netflix, the king of streaming, going head-to-head with Paramount. Netflix placed a massive $83 billion bid, only to be met by a staggering $108 billion hostile offer from Paramount. Why pay such a premium? Because in the world of content, size is the only shield. To compete with tech titans and AI-driven platforms, traditional media must consolidate. This $100 billion chess game is a direct result of a government that is now more likely to allow these giants to merge rather than forcing them to stay small and vulnerable. If you're finding value in this video, please consider subscribing. It helps me create more content like this for you. It's not just tech, it's the literal backbone of America. Look at the $250 billion rail merger between Union Pacific and Norfolk Southern. This created a transcontinental juggernaut. In previous administrations, a deal this size in a vital utility sector would have been unthinkable due to monopoly fears. This merger is about efficiency and logistics dominance. By combining networks, they reduce overhead and dominate the supply chain. For investors, this means a massive shift in how we value industrial stocks. We are moving from a fragmented market to one where a few super majors control the flow of goods across the United States. Who wins when companies merge? The bankers. Investment banking fees have soared to a near-record $135 billion this year, a 9% jump. The big six banks, including JP Morgan and Goldman Sachs, are seeing their market caps swell by an additional $600 billion. They aren't just witnesses, they are the architects of these deals. Analysts are using enterprise value calculations more than ever to justify these prices. With less stringent capital rules, like the easing of Basel III requirements, banks have more firepower to fund these multi-billion-dollar acquisitions. When the banks are winning this big, it usually signals a long-term cycle, not a short-term bubble. But beware, this isn't a tide that lifts all boats. We are seeing a K-shaped recovery in M&A. While mega deals over $10 billion are breaking records, with 68 such deals this year, smaller transactions and private equity activity are actually lagging. The big are getting bigger, while the small are struggling to find buyers. As an investor, you must distinguish between strategic buyers and financial buyers. Strategic buyers, like Apple or Disney, are buying for long-term dominance. Financial buyers, like private equity firms, are still cautious due to the cost of debt. If you are betting on a small-cap company being bought out, make sure they have a strategic moat, not just a low price tag. What is the hidden engine inside these deals? Artificial intelligence. Companies are realizing that building AI from scratch is too slow. It is cheaper and faster to buy the data and the talent. We are seeing industrial firms buy tech startups not for their revenue, but for their algorithms to automate factories and logistics. The buy versus build debate is over. In 2026, if you aren't buying AI capabilities, you are falling behind. This urgency is driving premiums higher. CEOs are paying 30 to 50% above market price because they know that being second in the AI race is the same as being last. Time is the most expensive commodity on Wall Street right now. The magic word in every M&A pitch is synergy. Investors want to know, does 1 plus 1 equal 3? By merging, companies claim they can cut redundant costs and cross-sell products to a larger audience. This is the synergy value formula that justifies those massive $100 billion price tags. However, history shows that 70% of mergers fail to deliver the promised synergies. As a sophisticated viewer, you must look past the CEO's PowerPoint. Check the accretion-dilution analysis. If the deal doesn't increase the earnings per share, EPS, within the first 2 years, it might just be an ego trip for the CEO at the expense of the shareholders. So, where does this leave us? We are witnessing the birth of a new American corporate oligarchy. The $4.5 trillion boom of 2025 is just the beginning of a multi-year restructuring. With a deregulatory wind at their backs and AI as the prize, the giants of industry are moving faster than ever. Your move is to stay informed. Don't just follow the headlines, follow the regulatory shift and the strategic moats. Position your portfolio where the big money is flowing, into the consolidators, not just the consolidated. The era of the mega deal is here. Are you ready to profit from the earthquake? Subscribe for more deep dives into the world of finance.